Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm here with Brian Gaynor, the Executive Director of Millford Asset Management. And Brian, the reason we've come to talk to you today is we really enjoyed your column in the Herald on Saturday about the potential sale of the Crayford Farms to Chinese interests and your comparison with the dairy industry and the forestry industry and what's happened there over the last 20 to 30 years. Now, first of all, Pangjin Group has got a bid in for the Crayford Farms that's been accepted by the receivers. It just needs the Overseas Investment Office's approval. You've described this as an important precedent. Why do you see it that way?
Because the history of New Zealand is if we sell an asset in one area, whether it be forestry or brewing or say the publishing industry, we tend to sell others fairly quickly. Same happened with banking. And I think it just sets a precedent. And it's important that we establish at the beginning whether this is a precedent that we want to continue or else it's something that we think is of such important national interest that we should take some steps to ensure that it doesn't occur, or it occurs in such a way that's an advantage to us rather than a disadvantage.
Now, you've drawn comparisons between the dairy industry and the forestry industry. Now, obviously, forestry industry perhaps hasn't fulfilled its potential for New Zealand. What do you think went wrong?
Well, if you look back at the forestry industry 30 years ago when I started in the industry in New Zealand, it was certainly considered to be the one that was going to be the major export earner of New Zealand. It was considered to be the industry that was going to be the great wealth creator. In fact, the stock market was completely dominated by forestry or timber companies. And the number one job that you had was a forestry analyst. I was a forestry analyst, and you were at the top of the rung in terms of a stockbroking firm. Fletcher Challenge, obviously a major company, Tasman Pulp and Paper, etc. What went wrong? The industry got into a certain amount of difficulty. It overstretched itself during the boom of the 1980s. Companies got themselves into difficulty. And we did what we always tend to do when our companies get into difficulty. We accept an offer from an overseas purchaser. And as soon as that started, and it started off very quickly back in about 88, 89, in the space of the following 10 years, virtually all our forestry companies and all our forests became offshore owned. And as a result of it, there's been almost no investment in the industry. And when we compare ourselves with Chile, for example, which was seen to be a similar company, Pinus Radiata, it's completely surpassed us in terms of exports. One of the major companies in Chile last week announced a $600 million investment in a new pulp plant. We've had nothing new in the last 30 years, and now we're exporting logs, low-value logs, which actually adds very little to the New Zealand economy. In fact, it's a disadvantage to our sawn timber millers. Many of them complain that they can't get any logs because the overseas owners have contracts with overseas purchasers. In actual fact, there's some very good examples where sawn timber millers in New Zealand are shutting down. There's one in Northland a few weeks ago, whereas in Korea, the sawn timber industry, and there's a huge amount of timber mills in every small little village, are prospering because they're importing logs from New Zealand. Now, I'd hate that to occur in the dairy industry.
Is one of your fears here that we sell off lots of our farms to Chinese and other foreign interests and just end up as bulk milk powder exporters instead of value-added products?
That's right. It's mainly to do with that. The real way that you create value, you create wealth, is the added value. The more you can go downstream. In actual fact, distribution profits are normally higher than the amount that you get at the farm gate. I remember when there was a lot of meat companies listed on the stock market, we worked out that about 10% of the total value of the meat when it was sold in the English stock market went to the farmer, about 20% went to the meat company here, and about 40 to 50% went to the distributor in the UK. So in actual fact, if we just export the raw material, the commodity, we get very little of the value that's in the complete chain. And that certainly happened in forestry, and that's why the forestry industry has really not fulfilled its potential. The dairy industry has got huge potential in New Zealand, but we will lose a lot of that potential if we just export the raw material commodity product.
So what we ought to be doing is setting up distribution chains around the world?
Absolutely, and this is where Fonterra comes in. Fonterra has done a very good job, but unfortunately it's capital constrained. I mean, if you compare it, for example, against Nestle, Fonterra has capital of just over 5 billion New Zealand dollars, whereas Nestle has capital of 88 billion New Zealand dollars. So, in other words, Nestle has about 20 times more capital than Fonterra. The way that we are going to be able to compete in these huge, big dairy markets is that we have a strong Fonterra and a well-funded Fonterra, and hopefully even another company comes through in New Zealand. If we don't have that, we will just end exporting our raw material products, and most of the value will be captured by the big distributor offshore, whether it be a retail outlet or somebody like Nestle.
But how can we do that with Fonterra when it's a cooperative and the farmers obviously are very reticent to bring in any outside investors at all?
Well, we've got to work on the farmers. I know they are reticent, and this is one of the problems we see. Ironically, to me, the Crayford farm even adds to that, because what I get all the time is when I speak to farmers or other people, they say, oh, we'll be taken over by foreign interests, because, of course, they're now looking at their industry. In the last few days, I've had a few phone calls and saying, well, you're a bit late, because already a huge amount of the farms have been purchased by overseas interests. So the farmers have become incredibly defensive. They see themselves protecting their patch, and one doesn't blame them in a certain degree, but we have got to change that mentality, because it's much better to have a strong, internationally competitive, aggressive Fonterra rather than a defensive, weak Fonterra. And at the moment, Fonterra to me has done an excellent job, but it has got chains around its neck, and those chains need to be loosened a little.
In terms of your views on Crayford, I mean, do you have a particularly strong view on foreign ownership of New Zealand land, farmland, or is it just your sort of broader concerns about the dairy industry? And how do you feel about foreign buy-up of our say listed companies, and how that compares to farm ownership? Is it more important that we keep the farms than the companies, for example?
Well, my own belief is that if you're to ask me, we talk about bridging the gap with Australia, and if you ask me what is one of the major reasons why the gap with Australia has got wider, is the fact that we no longer own so many of our assets. You take the banking industry, so it's not just farms or anything. We sold the Bank of New Zealand, for example, for 1.5 billion New Zealand dollars. The bank has paid its shareholder in Australia 5.1 billion since it was taken over. So we sold it for 1.5 and has paid dividends of 5.1 billion in that period of time. I could go through all the other assets that we've sold. And by selling all your assets, you effectively become, I hate saying it, but a bit of a serf in your own country. The wealth gets transferred offshore. And overseas owners don't have the same interest in your own country and as developing it as domestic owners would have. For example, somebody who's a local director of a company who's going to local football games and is mixing with people at the theatre is going to have a lot more interest in New Zealand than someone who's making a decision from Sydney or New York and only comes here twice a year, jets in and spends a few days here. So I think most countries are better off if they own most of their strategic assets. But I'm not against. I mean, my way of doing it is to try to convince people not to sell rather than to have legislation saying that you can sell. But it's a hard task in New Zealand because we do tend to take the offer, particularly in positions where companies are going through a poor period. And that's, of course, what happened to the Bank of New Zealand. That's how it happened to Fletcher Energy, Fletcher Paper. Look, there's a list of them a mile long. You know, even today we had New Zealand Farming Systems Uruguay with a new takeover offer. And that's another company, although it's not New Zealand-based, which the overseas purchaser took advantage of a temporary lull in the market and difficulties the company had to make I would say, a pretty cheeky offer last year, and another one again today.
Look, obviously the comparison with Australia is always there. In Australia, they have been looking to bring in a resource tax. Do you think perhaps that New Zealand ought to look at introducing taxes on milk powder or log exports in an attempt to try and get more sort of value-added development of those products here?
I'm not really keen on that. You know, that wouldn't be my answer. My answer would be to try to convince New Zealanders to take the long-term view. I mean, I know there's other bidders for the Crayford farms, but they have taken, it does appear there's a much more short-term view than the bidders from offshore, the Chinese. So I wish we would take, I'd prefer to convince people to take a long-term view. I'd prefer us to have more equity capital in New Zealand, more savings in New Zealand, so that we had enough capital to compete against overseas interests. But of course we don't, because in the last 20 years there's been a real swing away from investing in the productive sector to investing in residential property. So we don't have the amount of capital available in New Zealand to compete with offshore interests.
How do we change our mentality to one that looks more long-term? And I mean, obviously with savings, with KiwiSaver, we're beginning to build up a savings base, but about 80% of that money is being invested offshore. Should we legislate to prevent that?
No, once again, we can't do that. It's a matter of convincing people the merits, because there's actually huge advantages of investing in New Zealand, particularly from a tax point of view. You know, we've got some very high yielding stocks in New Zealand, fully imputed dividends, and if you compound that over a period of time, as long as those companies are competing well, I'd be quite surprised if the KiwiSaver funds that are invested in New Zealand, particularly the equity market, on an after-tax basis, are not doing substantially better than the money that's invested offshore. But for some reason, New Zealanders are convinced that you're always going to do better offshore, even though the New Zealand share market on an after-tax basis, when you take into account dividends, has actually done pretty well since the KiwiSaver scheme has come in.
But obviously the New Zealand share market has a dearth of new listings, not much in the pipeline, perhaps except for the SOEs, and the average daily turnover is about 60 million compared to a couple of billion in Australia, so we do need more life in that share market. Any bright ideas on how we could get that?
No, I'm hoping the younger generation that we will see. We saw a wave 30 years ago in the early 1980s when people in their even late 20s, I mean, Craig Heatley was only 26, 27 when he brought Rainbow to the market. We don't see any of that these days, and I'm just hoping that there's a new wave of young entrepreneurs who come on the market. I keep my fingers crossed hoping, but even in the last few days I've seen a few possible IPOs deferred. There's not there's an unwillingness to list in New Zealand, and one of the reasons that I'm always getting is the fact that we'll be taken over by foreign interests. We've created this momentum here that it's almost taken for granted that, you know, an overseas interest will come in and buy you, and New Zealand shareholders will sell out, and the next thing the company's gone and it's overseas owned. So unless we break that cycle somehow or another, we aren't going to give the confidence to young entrepreneurs to say, I'm going to list my company. You know, because if you're, say, 35, you want to be around for 20, 25 years with your company. But if you're convinced that overseas shareholders are going to make a bid for you, and that New Zealand investors are going to accept the offer, there is a reluctance to list. Otherwise, you do what Jim Delegate does with Delegates Group. He keeps 60% of the company because that's his way of ensuring that the company remains in New Zealand and he remains effectively in control of the company.
Perhaps that's a model for more New Zealand companies to pursue.
Yes, I was against that kind of a model for a while because I thought that, you know, it didn't give minority shareholders the kind of representation that they might want. But the more I've seen how Delegates Group has operated, and it's been an incredibly successful company offshore, and it's got a great brand in Oyster Bay, the more you begin to think that maybe that is not a bad model. And if Fonterra adopted that model, for example, as the Delegate family has with Delegates Group, it means that they keep control of the company. And if that's what they want, they're better doing that rather than making it capital constrained, where it can't really go out and have the huge kind of marketing clout that you need to have to compete with the Nestle's. But the marketing end is where you actually make the big margins. That's where the money is being made. And if you're not going to have the capital to participate in that on a level with the major international giants, you won't get the level of returns back to New Zealand, to the farmers ultimately, as they're entitled to get.
Well, thanks for that, Brian. That's Brian Gaynor, the Executive Director of Millford Asset Management, and I'm Gareth Vaughan at interest.co.nz.